Welcome back to AI Unraveled, your weekly strategic briefing on the business impact of artificial intelligence. It is the fourth week of January 2026. If you are waiting for AI to disrupt the workforce, stop waiting. Amazon just announced it is cutting 14,000 corporate jobs to pivot to AI. At the same time, Tesla has removed standard autopilot from new cars, forcing buyers into a subscription model for self-driving. But is all this AI investment actually paying off? A new report from PwC says no. 56% of CEOs report exactly zero financial return from their AI projects so far. Also this week, Google promises an ad-free Gemini. Apple is secretly building an AI pin. And Elon Musk turns on a 1 gigawatt supercomputer that uses more power than the city of San Francisco. But before we dive into the weekly rundown, are you drowning in dense legal text? Gemini is the new audio intelligence platform that turns 100-page healthcare or energy mandates into 5-minute executive briefings. Whether you are navigating Bill C-27, Canada, or the CMS 0057F interoperability rule, USA, our AI agents decode the liability so you don't have to. Start your specialized audio briefing today at jamgamind.com. This podcast is created and produced by Etienne Newman, senior software engineer and passionate soccer dad from Canada. Now, let's unravel the week.
Welcome back to the Deep Dive. We are officially in the thick of it. It is the week of January 18th to January 25th, 2026. And I have to say, looking at the stack of reports, the leaked emails, and the earnings calls we have on the table this week, the vibe has shifted.
It really has.
If you are managing a portfolio, running a P&L, or just sitting at your desk trying to figure out if you're going to have a job in 6 months, this is the week that changed the math.
It really is. You know, we often talk about paradigm shifts in this industry, and honestly, 99% of the time, it feels like marketing fluff.
Right. It's just a new buzzword.
It's usually just a new iPhone color or a slightly faster chip wrapped in, fancy language. But looking at the news from just these last 7 days, we are seeing a genuine, massive divergence.
A divergence.
It's almost like plate tectonics. You can feel the ground moving under your feet. It's not a tremor. It's a fundamental shift in the landscape.
How so? Paint the picture for us. What are these two plates that are diverging?
Well, on one side, you have the builders, the hardware guys, the infrastructure giants, the people pouring concrete in Memphis and launching satellites into orbit.
The ones laying the physical foundation.
Exactly. They are expanding at a rate that is, frankly, terrifying. I mean, they are spending money like it's water, betting the entire farm on massive, massive scale.
And on the other side, who's pulling away from them?
The users, the corporations, the enterprises trying to actually implement this stuff. They are hitting a wall. We are seeing a collision between massive capital expenditure and a brutal reality check on efficiency.
So the builders are building faster than the users can use.
In a way, yes. The check has come due, and for a lot of companies, the account is looking a little light.
That is exactly what we are here to unpack. We've got a massive agenda today. We're talking about the white-collar recession becoming official with Amazon, and we'll get into the specific numbers there because they are staggering.
Oh, they're breathtaking.
We're looking at why 56% of CEOs are seeing exactly $0 in return on their AI spend.
That statistic is going to keep some people up at night. I think it already is.
Absolutely. We've also got Tesla changing the rules of ownership in a way that feels unprecedented, effectively turning your car into a subscription box.
A very expensive rolling subscription box.
And we've got a hardware war that has moved from server rooms to low Earth orbit. I mean, it is a heavy week.
There's no other way to put it.
So let's not waste any time. Let's get into the story that is dominating every Slack channel and boardroom right now. The labor shift. Amazon. The headline that broke this week is 14,000 corporate jobs cut, starting next week. Now, we've seen layoffs before. We saw them in 2023, 2024. But this isn't just a bad quarter layoff, is it?
No, and that's the critical distinction our listeners need to make. This is structural.
Yeah.
And that's the word to key in on, structural.
Right. Not cyclical.
Not cyclical. Amazon is planning to eliminate about 30,000 corporate roles in total. To put that in perspective, that is roughly 10% of their entire office workforce.
10%. That is 1 in 10 people walking the halls in Seattle or Arlington. It's a huge number.
It's a staggering number. And the 14,000 you mentioned, that's just the wave starting now. That is the immediate execution. There's more to come.
And we have to be specific about who is getting hit here. Because I think there is a misconception, usually when we talk about Amazon, that layoffs mean warehouse workers or drivers or logistics people.
Correct. This is not about the people packing boxes.
Hmm.
The cuts are targeting technology, human resources, marketing, and finance.
The core of the corporate machine.
These are the engines of the corporate back office. These are the six-figure jobs. These are the people who manage the people, who manage the processes. And what makes this story so different from the layoffs of the past is the justification. CEO Andy Jassy wasn't vague about this.
Right. Usually you hear things like macroeconomic headwinds or restructuring for agility.
Corporate speak.
Generic corporate speak that doesn't really mean anything. What did Jassy actually say?
He explicitly linked it to automation. The strategy is to automate repetitive tasks using AI tools. And this is the critical part. Shift those resources to high-growth areas like AI development and cloud infrastructure.
So just to be crystal clear, they are firing the people doing the work to hire the people building the machines that do the work.
In a nutshell, yes, that's the trade. This is the signal event. For a long time, the AI taking jobs narrative was theoretical. It was something that might happen in the future.
Oh, maybe in 5 years, AI will do your spreadsheet, that kind of thing.
Precisely. Amazon, a trillion-dollar entity, just made it a line item on their P&L. They are trading human headcount for AI efficiency, and they're not hiding it.
It feels like the blueprint, doesn't it? If you are a CFO at a Fortune 500 company and you see Amazon, the king of efficiency, the company that invented the modern supply chain doing this, do you follow suit in 2026?
How can you not? That is the fear.
Yeah.
If you are a CFO looking at Amazon's move, you're asking yourself, why am I paying for a 50-person finance team when Amazon is running leaner with better tools?
It gives you the cover.
It validates the model. It gives permission to every other board to demand the same cuts. It's the white-collar recession, moving from a concept in an analyst report to a quarterly strategy.
And think about the departments mentioned. HR, marketing, finance. These are areas that rely heavily on processing information, synthesizing data, and communication.
That is the sweet spot for the current generation of LLMs. It's what they do best.
It really is. I mean, think about HR. Sourcing candidates, screening resumes, writing job descriptions, handling initial onboarding paperwork. These are all tasks that are, frankly, easily automated.
And marketing. Drafting ad copy, creating social media posts, analyzing campaign performance data. And AI can do that 24 hours a day without a coffee break.
And finance, reconciling accounts, generating quarterly reports, forecasting budgets based on historical data. The list goes on and on.
It does. If you have an AI agent that can do all of that, the manager layer that oversees the people doing that work starts to look, well, redundant.
Expensive.
Very expensive. Amazon is just the first to say the quiet part out loud at this scale.
But there is a fascinating contrast here. While Amazon is cutting staff because they can automate, we have another giant that is failing because they can't physically produce the goods.
You're talking about Intel?
I am. Look at their week. It was a bloodbath. Intel's stock plunged. They reported a net loss of $333 million in the fourth quarter.
Which is a staggering number for a company that is supposed to be selling the shovels in a gold rush. Everyone needs chips. We are in the biggest compute boom in human history. How is Intel losing money?
Exactly. How do you lose money selling water in the desert? It shouldn't be possible.
It comes down to execution in the physical world. They underestimated the demand for AI chips in data centers. It's a supply chain nightmare. CFO David Zinsser admitted that these shortages are going to continue through the first quarter of this year.
So they're leaving money on the table.
Billions. They're hoping to improve by mid-year, but in this market, 6 months isn't eternity. Their competitors are eating their lunch while they try to fix their factories.
So they have the customers, they just don't have the product.
Exactly. They are struggling with low manufacturing yields. And for those listening who aren't in semiconductors, yield just means how many usable chips you get out of a silicon wafer.
It's a percentage game.
A very difficult percentage game. It's incredibly difficult physics.
Mm-hmm.
You are using extreme ultraviolet light to print circuits that are just a few atoms wide. If a single speck of dust lands on the wafer, a billion-dollar chip can be rendered useless.
It highlights this incredible fragility in the physical world. Amazon can write a script to replace a marketing manager overnight. That's software. It's frictionless. You press enter and the code runs.
Right.
But Intel cannot magically spin up a fabrication plant or fix a yield issue on a nanometer scale. That takes time, money, and physics.
Atoms are harder than bits. That's the lesson here.
Yeah.
You can scale software infinitely with a copy-paste command. You cannot copy-paste a $20 billion factory.
It really paints a picture of two economies running in parallel. The frictionless software economy where labor is evaporating, and the friction-heavy hardware economy where they can't hire or build fast enough.
And that tension is where the opportunity and the danger lies for investors right now. If you are betting on efficiency, you're looking at Amazon. If you're betting on infrastructure, you're looking at the bottlenecks like Intel. But you have to pick your bottleneck carefully, because if they can't produce, your investment is dead in the water.
Speaking of picking your battles, let's pivot to the money. Because for all the jobs being cut to save money with AI, the actual returns on AI investment for the average company are looking, well, let's call it what it is, bleak.
Bleak is a polite way to put it. We need to talk about this PwC report.
Let's unpack this. PwC surveyed 4,400 CEOs. That is a massive sample size. This isn't just a few disgruntled tech bros on Twitter or a small focus group. This is the global C-suite speaking.
Right. From every industry all over the world.
What did they find?
They found that 56% of CEOs report zero financial returns for their AI investments so far. Zero.
That is mind-blowing. We are 3-4 years into the generative AI boom, and more than half the companies haven't made a single dime.
Not a dime. In fact, they probably lost a lot of money. The report gets worse. Only 10% to 12% are reporting any actual revenue gains or cost savings.
So for roughly 90% of companies, this has been a cost center with no ROI.
A very expensive one.
So where is the disconnect? We just talked about Amazon firing people to save money. Why isn't everyone else seeing these gains? Why is Amazon the outlier?
According to Mohammed Kande, the global chair at PwC, it's not the AI that's the problem. It's the boring stuff.
The boring stuff? What does that even mean?
Data governance, business processes, clean data sets. It turns out you can buy the most expensive GPUs on the planet, the Ferraris of computing. But if your internal data is a swamp of disorganized PDFs, legacy spreadsheets, and bad formatting.
You have no roads to drive that Ferrari on. I love that analogy.
It's the perfect analogy.
Yeah.
So companies bought the hype, they bought the chips from NVIDIA, they installed the models from OpenAI or Anthropic, and then they realized their own house wasn't in order.
Precisely. You can't put a jet engine on a covered wagon and expect it to fly. If your sales data is in Salesforce, your customer support data is in Zendesk, and your finance data is in some ancient SAP system from 1998.
And none of them talk to each other.
Right. An AI model can't access that to give you any real insights. It just hallucinates or gives you error messages. The model is only as good as the data you feed it. Garbage in, garbage out.
And this is creating a crisis of confidence. The survey showed that CEO confidence in revenue growth is at a 5-year low. It's down to 30%. In 2022, that number was 56%.
So the hype cycle is officially over.
We are in the implementation trough, and it is deep and it is muddy.
It is. And this is the dangerous part of the cycle. This is where the board starts asking, we spent $50 million on this AI initiative, show me the money. And if the CTO says, well, we're still cleaning the data, heads start to roll.
Absolutely. The patience for we're experimenting is gone. Now it's about P&L impact.
And it's not just the traditional legacy companies struggling with this. Even the darlings of the AI startup world are hitting turbulence. We have to talk about Thinking Machines Lab.
Oh, the drama at Thinking Machines. This is a case study in volatility. I mean, it's like a Silicon Valley soap opera.
For listeners who haven't tracked this, Thinking Machines is the startup led by Mir Murati, the former CTO of OpenAI. This was supposed to be the dream team.
The A-team. They had the pedigree, they had the connections. They were the ones who knew how the sausage was made at the most important AI company in the world.
And this week, it looked like it was imploding. Mir Murati fired her co-founder, Barrett Zoff, in an all-hands meeting.
Wait, in the actual meeting, like in front of everyone?
In the meeting, publicly. The reason given was poor performance and talking to competitors. But the reaction was immediate. 2 senior researchers quit via Slack before the meeting even ended.
That is brutal. That is a morale death spiral. You can just imagine the private Slack channels lighting up while the CEO is still talking, people updating their LinkedIn profiles mid-call.
And the kicker. Out of the 5 staff members who left this week, 4 of them went right back to OpenAI.
It's like a boomerang. They left OpenAI to build something new, probably for a huge equity package, realized it was chaos, and went right back to the mothership.
It's a huge vote of no confidence. It highlights the talent war. Thinking Machines is trying to raise capital at a $50 billion valuation.
50 billion, with a B.
But investors are, to quote the reports, rattled. If you can't keep your co-founder and your lead researchers, how do you justify a $50 billion price tag?
You can't. It shows that even the smartest people in the room, the people who built ChatGPT in the first place, are struggling to build a stable business structure.
It connects right back to the PwC report. Whether you are a legacy bank or a hot startup, execution is incredibly hard.
Execution is everything. Ideas are cheap. Models are becoming commodities. But building a company that functions, that's the hard part. And just to layer one more example on this, Meta.
Right. Facebook. They have basically unlimited resources. Mark Zuckerberg has been all in on AI for years.
All in. Meta's superintelligence labs just delivered their first major models to internal teams. This is likely the next iteration of Llama, probably Llama 4. But CTO Andrew Bosworth had to admit something difficult this week.
Oh, was that?
He said the models need significant post-training work before they are ready for consumers.
So they're not ready for prime time.
Far from it. Even Meta, with essentially unlimited money in compute, is finding that the next leap isn't coming easy. You can't just throw more GPUs at the problem and expect magic to happen.
So the easy gains are gone, the low-hanging fruit has been picked.
That's the takeaway. We aren't seeing those magical jumps in capability every 3 months anymore where the model gets twice as smart.
Yeah.
Now we are in the hard grinding phase of making this stuff actually work reliably and profitably, the engineering phase.
Which brings us perfectly to the next segment. Because if you can't make money selling the hardware due to shortages, and you can't make money implementing the software due to dirty data, you change the business model entirely.
You trap the customer.
The subscription trap.
Let's talk about Tesla. Because if you bought a Tesla in the US or Canada this week, you might have noticed something missing.
You notice that Autopilot, the basic driver assistance feature that has been standard for years, is gone.
Just gone. Poof. Removed from new vehicles. If you want the car to steer itself on the highway, which used to be included, you now have to buy full self-driving or FSD.
And the pricing structure on this is fascinating. It's not just a price hike, it's a deadline. It feels like a high-pressure sales tactic you'd see at a timeshare presentation.
It really does. Until mid-February, specifically Valentine's Day, February 14th, you can buy FSD for a one-time fee of $8,000.
Okay. A steep price, but you own it, you pay it once, and it's yours for the life of the car. It's an asset. And after Valentine's Day.
The one-time option disappears. The only option will be a $99 monthly subscription. And Elon Musk has already said the price will increase over time.
Wow. This is a massive shift. They are forcing you into a rent-seeking model. You never own the feature, you just rent it. Even if you drive that car for 10 years, you are paying every single month.
Exactly. A 10-year ownership at that price is nearly $12,000. And the price will go up.
We have to look at the financials to understand why. Tesla's margins are falling, car sales are declining globally.
The competition from Chinese EVs is brutal.
Brutal. And the revenue they used to get from selling emissions credits to other automakers is drying up because everyone else makes EVs now. They need a new, reliable cash flow.
So the car becomes the printer, and the software is the ink.
Perfectly put. It's the saucification of the automobile. They want recurring revenue. Hardware is becoming a loss leader, or at least a lower margin entry point, to hook you into a lifetime of $99 plus payments.
It changes the definition of ownership. You buy the metal, but you rent the experience. And investors love subscription revenue. It's predictable. It doesn't fluctuate like car sales do.
But for the consumer, it's a bitter pill to swallow. You're paying $50,000 for a car and then another $100 a month just to use the features that are already built into it.
It's a huge psychological shift. We're used to buying a thing and owning the thing. This is different.
Contrast this with Google, because we got some interesting news from Davos regarding Gemini and ads.
Yes, DeepMind CEO Demis Hassabis was very clear. He confirmed there are no plans to put ads on Gemini anytime soon.
Which is surprising, isn't it? Google is an ad company. That's their DNA. That's how they pay for the free coffee in the cafeteria and everything else.
Their entire business model. But Hassabis made a very sharp point. He threw a bit of shade at OpenAI. He noted that OpenAI started testing ads in ChatGPT recently.
Right.
His implication was, OpenAI needs the revenue.
But Google
does not.
Because Google has the search monopoly, printing $200 billion a year.
Exactly. Google can afford to run Gemini as a loss leader or a pure utility to keep you in their ecosystem without junking up the interface. They can subsidize the compute cost with search profits. OpenAI, on the other hand, is burning cash.
They have Microsoft's backing, but they're still a standalone company.
They are, and they have to find a way to pay the bills. The compute bill alone is astronomical.
Speaking of burning cash, we saw some internal documents leak this week regarding the Microsoft and OpenAI partnership. This came out of Elon Musk's lawsuit against OpenAI.
These documents are a goldmine for historians of this industry. They reveal that Microsoft invested in OpenAI specifically because they were terrified. They had lost OpenAI to Amazon AWS initially in 2015.
I didn't know that. So OpenAI was an Amazon shop originally.
Yes, in the very early days, OpenAI was using AWS. Microsoft had to win them over with a $50 million compute donation in 2016, and then the big $1 billion investment in 2019.
So this has always been a proxy war.
Always. A proxy war between the cloud giants Azure versus AWS. Microsoft saw that the next generation of computing would be built on these models, and they couldn't afford to have the leading lab building on their rival's platform.
And now OpenAI is generating $20 billion in annual revenue.
Which is incredible growth. Unheard of, really. But when you look at the capital expenditure required to keep going, you understand why subscriptions, and maybe eventually ads, are inevitable for them. They don't have the search engine subsidy that Google has. They have to eat what they kill.
So everyone is scrambling for a moat. Tesla wants a subscription moat because they can't rely on car sales. Google has a search moat so they can keep their AI clean. OpenAI is trying to build a product moat. But to build any of this, you need power.
Raw, physical power.
And that brings us to the infrastructure wars.
The scale is just mind-boggling.
Let's talk about the sheer scale of what happened this week, because I think people hear numbers and glaze over. But we need to visualize this. xAI, Elon Musk's AI company, they launched Colossus 2.
The numbers here are hard to comprehend. This is a 1 gigawatt training cluster.
1 gigawatt. For context, what does that actually mean?
Okay, so 1 gigawatt is 1 billion watts. It's roughly the peak electricity demand of the entire city of San Francisco.
Wait, say that again. 1 computer cluster?
Is using more power than a major American city.
Yes. Imagine every light, every refrigerator, every streetcar, every office building in San Francisco, all that power channeled into one building in Memphis, Tennessee, to train an AI model.
That is absolutely insane. And they aren't stopping there, are they?
No. Musk announced it's going to 1.5 gigawatts in April, and they're targeting 2 gigawatts later with a new building they've codenamed Macro Harder.
Macro Harder, spelled like harder?
Subtle, right. A clear shot at Microsoft.
Very Musk. But the strategy here is distinct from OpenAI or Anthropic.
Completely. OpenAI relies on Microsoft's Azure. Anthropic relies on Amazon's AWS. They are tenants. They rent their space.
Musk is building his own house. He raised a $20 billion Series E to fund this. He doesn't want to be beholden to a cloud provider. He wants to own the metal.
So if Microsoft decides to change the terms or Amazon runs out of capacity, Musk doesn't care.
Exactly. Vertical integration. It's the same thing he did with Tesla. Make the battery, make the software, make the car. Now he's doing it with AI. Make the chip, make the data center, make the model.
But the hardware war isn't just on the ground, it's going to space.
This was a sleeper story this week, but it's huge. Blue Origin, Jeff Bezos' space company, announced TerraWave.
This is another satellite network, like Starlink.
A massive one. 5,408 satellites in low Earth orbit.
Directly targeting Starlink. The billionaire space race continues.
Directly. But look at the specs. They're promising data speeds of up to 6 terabits per second, and they are specifically targeting enterprise and data centers.
Ah, so while Starlink connects rural homes and RVs, Blue Origin wants to connect the AI cloud.
That's the play. AI training and inference require massive data transfer between data centers. If you can move that data through space faster than you can through fiber optic cables under the ocean, or at least offer a redundant lower latency layer, that is incredibly valuable.
So the battle for AI supremacy is now literally being fought in orbit.
100%.
We've got supercomputers in Memphis, sucking down gigawatts, satellites in space. Let's bring it down to what we're actually going to hold in our hands. Because the hardware wars are also about the device.
The search for the post-smartphone device. The holy grail. Everyone wants to be the one who kills the iPhone.
And ironically, Apple might be trying to kill the iPhone themselves. We got a report from the information about an Apple AI pin.
Yes. Launching potentially in 2027. A magnetic wearable, aluminum and glass, 2 cameras, 3 microphones. You clip it to your shirt.
It sounds familiar. Very familiar.
It sounds exactly like the humane AI pin.
Which, frankly, was a disaster. It overheated, the battery life was terrible, the projector was gimmicky.
It was. It failed, and the company shut down. So it's risky for Apple to go down this exact form factor. But Apple have a history of taking existing ideas and polishing them until they work.
Right, they didn't invent the MP3 player or the smartphone.
They just perfected them. So the question is, can they perfect the wearable AI pin where humane failed?
But Apple isn't the only one. OpenAI's making a move too, right?
The I/O device. This is the collaboration between Sam Altman and the legendary designer Jony Ive.
The guy who designed the iPhone. He's coming for his own creation.
Right. We learned it's launching in the second half of 2026. It's audio-based, no screen. And OpenAI has been poaching talent from Apple to build it. Engineers who worked on the Apple Watch and iPad.
So one is a visual first pin, the other is an audio first. Something. It feels like a high-stakes bet on voice.
It is. Can you interact with the computer purely through conversation? If you can, you don't need a screen. It's a fundamental bet on the future of the user interface.
And then, of course, the ultimate hardware. The robot.
Tesla's Optimus. Musk said at Davos that they plan to sell humanoid robots to regular consumers by late 2027.
He claims they will do basically anything.
High reliability, high safety. It's a bold claim. But when you look at the timeline, Apple Pin in 2027, Optimus in 2027, OpenAI's device in 2026, everyone is betting that the way we interact with AI is about to change physically. We are moving away from typing into a glowing rectangle.
It feels like the interface is dissolving, the screen is going away. Which leads us to our final segment. The software itself is changing. It's not just answering questions anymore.
It's doing the work.
The agentic future.
And we had to talk about Cursor. For the developers listening, this is the story of the week.
It really is. Cursor is an AI code editor, but they did something incredible. They used a swarm of hundreds of AI agents to build a web browser from scratch.
In under a week.
Of a functional web browser from zero in less than a week.
But the breakthrough wasn't just raw speed, it was the structure. It was the management.
How did they manage hundreds of AIs without them stepping on each other's toes? Usually if you have too many cooks in the kitchen, you get a mess.
That was the initial problem. They found that when agents had equal status, they locked files, got confused, and became risk-averse. So they created a hierarchy.
Corporate management for AI.
Exactly. They built a judge agent to oversee planner agents and worker agents.
That is hilarious. They reinvented middle management for software bots.
They did, but it worked. The judge agent kept everyone in line, assigned tasks, and reviewed the code. They used GPT 5.2-a model we are seeing mentioned more often, and it performed better because it followed instructions and didn't drift.
What does this mean for a software engineer today? If I'm listening to this and I write code for a living, should I be scared?
I don't think scared is the right word. I think you should be paying attention. It means the job is shifting. You aren't writing code line by line anymore. You are orchestrating swarms.
You're the conductor of the orchestra.
You are the manager of the judge agent. You are moving up the abstraction layer. You become the architect, not the bricklayer.
And this agent concept is coming to consumers too. Apple is finally doing something with Siri.
Finally.
Yeah.
After years of being a punchline, the project is codenamed Campos. Apple is turning Siri into a full-blown chatbot in iOS 27.
But the twist is who is powering it. It's not Apple's own model, is it?
It's Google. Hassabis confirmed the partnership at Davos. Apple is paying Google roughly $1 billion a year to run Gemini inside Siri.
Wow. That feels like an admission of defeat for Apple's internal AI team.
It is a pragmatic move. Apple knows Siri lost the first round. Badly. They are outsourcing the brain to Google to catch up while they work on their own models in the background. It's a stopgap, but an expensive one.
$1 billion stopgap.
It shows that even Apple, the most valuable company in the world, can't win every battle alone. This stuff is just too hard and moving too fast.
And lastly, for the creators listening, YouTube is getting weird.
YouTube clones. Creators can now generate AI versions of themselves for shorts.
So I don't have to film. I just type a script, and my AI clone says it in a video.
That's the promise. You scan yourself once, and then you can generate content forever. But there is a massive tension here. In the same week, YouTube CEO Neil Mohan wrote a letter saying his #1 priority for 2026 is fighting AI slop.
Wait, so they are giving creators tools to make AI content, but they are also promising to fight low-quality AI content. That sounds completely contradictory.
It's the platform dilemma in a nutshell. They want the volume that AI provides. They want to compete with TikTok's infinite scroll, but they are terrified of the quality drop.
They want the good AI, not the bad AI.
Right. It's a fine line between a useful creator tool that helps you be productive and slop that ruins the algorithm and drives viewers away.
It seems like they're trying to have their cake and eat it too, and I'm not sure that's possible.
They are.
Mm-hmm.
And we'll see if the algorithm can actually tell the difference between a high-quality AI clone and slop.
I'm skeptical. We have covered so much ground today, from Amazon firing 14,000 people to xAI powering up a gigawatt cluster that rivals San Francisco.
It's been a week of extremes, truly.
If we zoom out, what is the one thing the listener should take away from this chaos?
It's the divergence I mentioned at the start. We are seeing a massive capital expenditure boom. Musk building clusters, Bezos launching satellites. The infrastructure is exploding at an exponential rate.
The builders are building.
But simultaneously, we are seeing a corporate efficiency squeeze Amazon layoffs, the PwC ROI crisis. The users are cutting back.
The builders are spending and the users are cutting. That's the core conflict.
Exactly. And somewhere in the middle of that crunch is where the real value will be found in 2026. If you can navigate the efficiency squeeze while leveraging the new infrastructure, you win. If you get stuck in the middle, you get crushed.
I want to leave everyone with one final thought, something that came out of Anthropic this week that gave me a bit of a chill.
The Constitution.
Anthropic released a new constitution for their model, Claude. It's an 80-page document on ethics and safety principles. But the ending.
It is profound.
Yeah.
It's not what you'd expect from a corporate document. The document ends by explicitly questioning if the AI has consciousness. It states, and I'm quoting here, "The moral status of AI models is a serious question worth considering."
Think about that for a second. We just spent an hour talking about companies firing humans to hire these models. If those models have moral status, if they have some form of consciousness, what does that do to the definition of labor laws in 2027?
Are we firing humans to enslave digital minds? It's a question we aren't ready to answer, but Anthropic is putting it on the table. It forces us to rethink the very nature of what we're building here.
It moves the conversation from, is my job safe, to what is a job and what is a worker? Heavy stuff.
Very heavy.
Keep your investments diversified, keep your data clean, and maybe be nice to your chatbot. We'll see you next week on AI Unraveled.
Stay curious.
That wraps up our briefing for the week. The signal for this week is friction. We are seeing friction everywhere. Friction in the labor market as Amazon automates jobs. Friction in the auto market as Tesla forces subscriptions. And friction in the boardroom as CEOs realize that buying AI is easy, but getting an ROI is incredibly hard. The magic phase of AI is over. The hard work phase has begun. Before we go, a reminder for the leaders listening. Are you drowning in dense legal text? JamgaMind is the new audio intelligence platform that turns 100-page healthcare or energy mandates into 5-minute executive briefings. Whether you are navigating Bill C-27, Canada, or the CMS 0057F interoperability rule, USA, our AI agents decode the liability so you don't have to. Start your specialized audio briefing today at jamgamind.com. This podcast is created and produced by Etienne Newman, senior software engineer and passionate soccer dad from Canada. Please subscribe and share. Until next week, keep unraveling the future.